Hello. In this video, we'll be going through a shareholders' equity comprehensive problem. The balance sheet of Consolidated Paper Incorporated included the following shareholders' equity accounts at January 1st. So here we're given in this table all the balances on January 1st for this company. And then there's all these transactions A through E that we need to account for. So let's get started. A. On March 3rd, the Board of Directors declared a property dividend of 285,000 shares of Liasco International common stock that Consolidated Paper had purchased in January as an investment for $828,000. That's the book value. The investment shares had a fair value of $3 per share and were distributed March 31st to shareholders of record on March 15th. So this is a property dividend because we're looking, this company that we're doing this for is Consolidated Paper. Consolidated Paper had shares of another company, of Liasco International, and they're distributing 285,000 of those shares. So for Consolidated Paper, this is an investment. This is an asset on their books. First thing we have to do is we have to right here, gain on investment. First step is whenever we distribute property as a dividend, it has to be at the fair value on date of declaration. So we're told that we purchased the stock in January for $828,000, and by March, the fair value is $3 a share. So if we take the 285,000 shares at $3, the fair value of Liasco International common stock is $855,000, and our book basis is $828,000. So we have to write up our investment by $27,000 in order for it to be at its fair value when we record the declaration. So it's going to be a two-step process on March 3rd. First, we have to increase our investment account. We're going to debit investment in equity securities for $27,000 and credit gain on investment for $27,000. Now we can actually record the declaration of the dividend, and whenever we declare a property dividend, we're going to debit retained earnings, and now it's going to be at the fair value of our investment, which we've trued up to $855,000, and we're going to record a property dividends payable for the same amount because now we've just declared it on March 3rd. It hasn't been paid yet. Now, the shareholders of record of March 15th, we don't have to do any sort of journal entry there. It's just that any shareholder, any entity that's a shareholder on March 15th will receive this property dividend. And now March 31st, when it's actually paid, that's when we're going to debit our payable that we recorded on March 3rd. So we're going to debit property dividends payable for $855,000. And now we're going to credit this investment. Now we've actually distributed out those investment to our shareholders. Okay, second item B, on May 3rd, a 5-for-4 stock split was declared and distributed. Before we go on, a 5-for-4 means for every 4 shares that you own, now you're going to have 5 shares. So essentially, we've given you a 25% dividend because if I multiply 4 times 1.25, I'm going to get to 5. So the stock split was effected in the form of a 25% stock dividend. So in this situation, they treated the stock split as a stock dividend, and that's how they get their 25%. That's a 5-for-4 split. The market value of the $1 par common stock was $10 per share. So let's see how we go about doing these journal entries. First, you have to figure out when we pay a dividend, it is only on outstanding shares. And when we have treasury stock, they are no longer outstanding because the corporation has bought them back. So here on January 1st, we were told that the common stock right here on this row, on the second row, there's 474,700 shares, But there's also treasury shares, which means that of those 474,000 issued, 4,700 have been bought back, and now they're not outstanding anymore. So when you're looking at the number of shares you have to calculate the stock dividend on, it's on 470,000 shares. It's the number of shares outstanding. So we're going to take the 470 shares multiplied by the par value, and this is a 25% dividend. So it's 117,500. Now, I just want to note that we multiply this by par value because this is a 25% dividend stock or stock dividend, right? So anything larger than 25% is considered to be a large stock dividend, or 25% and more is considered to be a large stock dividend. And so then when we calculate everything, we were only using par value. We're not using the market value of $10. Okay, back to this, 470,000 shares times $1 par value times 25% is $117,500. And when we have a stock split that's in effect a stock dividend, we record that a little bit differently than we would just a regular stock dividend, in that we're going to debit the paid in capital in excess of par for common stock for the $117,500, and we're going to credit common stock for the $117,500. Now, this little table right here is, we're just going to keep track of how many common shares we have outstanding. So we started with a 474,700. We know we have treasury shares of 4,700, so those are no longer outstanding. And now we just issued a 25% stock dividend for 117,500 shares, right? So we've issued this many more shares to the shareholders. So now we have a total amount of common stock outstanding of 587,500 shares. C. On July 5th, a 1% common stock dividend was declared and distributed. Okay, so in this situation, both happened on the same day. The market value of the common stock was $10 per share. Well, this is a small stock dividend because it's under 25%. So then we use the market value to calculate the amount of the dividend. First thing we need to know is we need to figure out what is our common stock shares outstanding. We had that in the previous slide right here. That's where this 587,500 shares comes in. So remember, this last transaction happened on May 3rd, and now on Part C, we're on July 5th. So it's important to keep building on the previous transactions. So we're going to take our 587,500 shares, multiply by the stock dividend 1%, multiplied by the market value. This is how it's different from a large stock dividend where we multiply only by the par value. Okay, so this gives us $50,750, and now we're ready to record this. Now, this is just a regular stock dividend. It's not a stock split. It's not a stock split that was effected in the form of a stock dividend, which means that when we do our debit, it's going to be just like a debit for any other dividend, which is to retained earnings. So we're going to debit retained earnings for the $58,750, and we have to credit our common stock for the number of shares, right, times 1%, because this is just a 1% stock dividend, times its par value, which gives us $5,875, and then the remaining amount goes to paid in capital in excess of par for common stock. Let's see how many common stock shares outstanding we have now. So now we've added this layer for July 5th, the issuance of a 1% stock dividend, and we had 587,000 shares before, times 1% means we're going to issue another 5,875 shares. So we increased our common stock outstanding by that amount, and now we have a new total of 593,375 shares. Part D. On December 1, the board of directors declared an 8% So 8% cash dividend on 97,000 preferred shares payable on December 28th to shareholders of record December 20th. So here's our preferred shares. We have 97,000 shares and we can get 8% dividend. Okay, so for preferred shares, we're going to take the 97 times 8% times its par value equals $7,760. And just like a regular dividend declaration, on December 1st, we have to debit our retained earnings, which reduces retained earnings by that amount, and we're going to credit cash dividends payable for $7,760. The date of record, December 20th, is no journal entry required. And then when we actually pay out that dividend, we're going to debit the cash dividend payable for the $7,760 and credit cash for the same amount. Let's go to E. On December 1, the board of directors declared a cash dividend of 60 cents per share on its common shares payable on December 28th to shareholders of record December 20th. So now again, we're going to look at how many shares outstanding do we have of common stock. We saw from the previous, from the previous slide or two slides, it was 593,375 shares. So we're going to take that amount, multiply by the 60-cent dividend, and we get $356,025. Again, same journal entries as we would record for a preferred stock cash dividend. We're going to debit retained earnings on the date of declaration for $356,025 and credit cash dividend payable. December 20th, the date of record is no journal entry required. And then when we pay it out on December 28th, we debit that cash dividends payable and credit cash for that $356,025. The last thing is that we're told prepare the shareholders equity section of the balance sheet for Consolidated Paper Incorporated on 12/31. Net income for the year was $870,000. So we had all these transactions, right? This is our balance on January 1, all these balances. And what I've done here, I've just recreated this January 1 column. For every single date that we had a journal entry, I've posted them all here. And every time something hit a shareholders equity account, I kind of put it if it was a plus or minus. So you see this in retained earnings, we had a minus 855,000. I'm going to reduce my retained earnings by 750. So when you do this, I just want you to keep in mind that, this is not this January 1 column. It's not in debit credit form. We're saying we have preferred stock for 97,000 and common stock is 474,700, et cetera, et cetera. You'll see treasury stock is a negative because we always reduce our shareholders equity section for treasury stock. So when we have a shareholders equity account, its normal balance is a credit balance. So when we had a debit, we had all these debits to retained earnings, it means we're reducing retained earnings. That's why I'm decreasing it. So this is a plus minus format, not debit credit, but you had to look at your journal entries of debit credit and reflect that on here using the plus minus format. So I did all that. And then right here, we were told in the previous slide that the net income for the year is $870,000. You should know that net income increases retained earnings because our formula for retained earnings is going to be our beginning retained earnings plus our current year net income, right? Minus our dividends. That's going to, that shouldn't be like that. Minus our dividends, any sort of dividends, whether it's property dividends, cash dividends on preferred stock, common stock, stock dividends, stocks, all kinds. So it gives me the ending retained earnings balance. So that's why when it told me that I have $870,000 in net income, I'm going to increase my retained earnings because the income flows into retained earnings. So now on here, on this last column on the right, the 12/31/20 XX. I have all my new balances after I've posted all the entries, and so my ending shareholders' equity is now $14,040,915.